It is time for the Cboe Exchange Traded Profile, and today we've got some fun stuff to talk about. We got 10 funds listed here at Cboe from Howard Chan's Kurv Investment Management. Howard, great to have you on the show. Thanks for joining.
Thank you. I'd love to be here.
Welcome to Chicago. Familiar, you guys have 10 ETFs listed here at Cboe, and the 10th one that launched in February was a copper income fund.
Yes.
Let's talk about that, because we were just talking metals, gold, silver. Is copper getting enough love?
I don't think so. And I think for us, we tend to be long-term investors. And what we're seeing is, especially with what's happening now, is that this deglobalization trend continues. And as countries become more independent, they need to secure their own defenses as well as natural resources. So we think that over long periods of time, most of these commodities will become increasingly important that investors should have exposures in their portfolios.
For the copper exposure, tell me about how that fits in, because the gold and the silver trade have been fascinating.
Yeah.
As I was just kind of arguing, they've kind of taken on these new volatility profiles in a way, but from your perspective, which is piling on income on top of those, that's kind of ideal, right? Because then you've got more to work with, the more volatile they are.
That's right. And so all three are run very much in the same way. And so the premium that we're trying to harvest is exactly the volatility premium, and from there we can distribute income. And we pick these particularly because traditional commodity investing doesn't generate income. So if you're an advisor or a client who wants to construct an income portfolio, you're generally underweight these exposures because there is no income component. So these strategies are meant to give the exposures that you want, whether it's from reserve assets all the way to risk growth assets like copper, to give that exposure in your portfolio without sacrificing income.
When you're dealing with copper and metals, derivative products, what about exposure to the underlying, and how do you kind of manage that? What should people know about? Are they getting any exposure to the direct metals or anything they got to worry about on that front?
We are not invested in the underlying metals. So in the copper is actually copper and minor exposure. So what we want to do is actually typically investing in metals is actually, because it's not a security, it's not as tax advantaged. And what we want to do is actually leverage options to get a similar long exposure. So typically we would get a synthetic long exposure. So a long call short put will give you the same economic exposure as actually having exposures to the underlying.
Okay.
But in
basically
this
synthetic, you're basically doing a 1-to-1.
Exactly.
Okay.
And then, but because options are securities, it generates what we call good income under the IRS. And so it's a whole different way in which you can get commodity exposures. And the other thing is that you can get physical exposures. Those are typically taxed at collectible rates like gold and silver, which is much higher. And the other way to get exposures may be through futures. But as the market's been very volatile, demand and inventory has been shifting, you have these issues with contango and backwardation. So what we want to do is actually a new form of commodity investing, which is to get spot exposure without the things that you have to worry about with futures. And then at the same time, generate good income on exposures that don't typically give you income.
99 bips, under 1%, but I think kind of that 75-ish, 85, 90. I think what you're talking about justifies it, maybe a few bips higher than if you're just doing this with a basic stock, because there's some more complexities here, and you're also kind of providing a service, which is exposure to something that may not be a traditional, they may not have the right brokers, they may not have the infrastructure set up to go and buy copper if they want. So you are also providing that service too.
That's right. So we obviously have very strong margin management and derivative exposure risk management in our portfolio, but differently, we're still the active managers. So the long-term goal for these strategies is to outperform the underlying. And over time, hopefully if we deliver that, that would justify all the operations and expenses of the fund.
Okay. When you are talking with advisors about the kind of category of things you're providing, which also includes single stock exposures, the metals side, are they finding this as a new kind of crucial part of their approach, and do they take it from the risk side of the portfolio, or are they taking it from maybe the bond side? I guess when you're deriving income, you could kind of argue for both.
Yeah, so I think one of the things that many have observed is that over the last 3 to 5 years, in a 60-40 portfolio, the reason why you have 60% stocks and 40% bond is that they're generally negatively correlated assets. But over the last 5 years, that correlation has actually get close to zero, so you don't get as much diversification. So for example, our gold strategy, people have been using as a replacement for bonds because it is highly negatively correlated with equities. But at the same time, some of our single name equity and other equity strategies, again, we look for this trade-off that advisors have to make. Typically, you have to make a trade-off between price appreciation and income. Growth stocks, they generally do not distribute dividends.
Right, they're too busy growing.
Exactly. And so they are usually underweighted if they're creating an income portfolio. So again, what we want to do is have better tools in the portfolio so that advisor can still create an income portfolio and have the exposures that they want without sacrificing the price appreciation.
Gold, your exposure, KGLD. The chart for gold we were just talking about is wild. That means you've got more to harvest in there. How much, I guess kind of when you launched this, did you think gold was going to behave the way it did? How has the volatility, kind of changed your expectations of how to run a product like this?
Yeah, and again, with most of our strategies, we go to our secular view, which is, as many people have heard about the debasement trade, people are allocating out of U.S. assets. They need something that retains value, and euro and renminbis are not really good substitutes, so the only thing that you can have is gold. So that was our long-term thesis, and typically vol for gold is, roughly, 1 or 2% standard deviations in a normal environment, and obviously in the last quarter, we've seen this skyrocket shape. That has helped the strategy because implied vol roughly 12-13% have increased to even let us generate better income in the strategy. It's fallen since then, and actually we prefer probably a more normal standard deviation expectations that, and we think this is a long-term story that is, even though we've had short-term falls, we think that this will be a long-term trend. People continue to allocate to gold. Yeah.
What kind of expiries are you using? How weeklies, monthlies?
Yeah. So we split it depending on the exposure. So for long-term exposure, so the 1-to-1 gold exposure, we typically do 3 months, and we use flex so that we don't have to roll as much.
Yep.
And then
hugely popular. Like a small portion, but a massive growth rate over the last couple of years because of funds like yours. Flex has just been blowing up.
That's right. And then the income generating option strategies on top of the long, we typically roll weekly, depending on the bid-ask spread. Some strategies like silver, where bid-ask is a little bit wider, we roll every 2 weeks to save ourselves some transaction costs. But generally, that has been pretty effective given that vol has gone up quite a bit in the recent environments.
Love the stuff on the metals. I want to make sure, though, we don't miss your single stock stuff. What utility is this? Just for a person who says, "Hey, I don't want to have to trade all the options myself, but I like this company, and I'd rather do this." Then what's the service you're providing, or what's the kind of market you're going for? Because do advisors use these, or is this mostly for a retail audience?
No, they're for both. And the two use cases are for advisors. Cover calls and other option strategies have been around since the 1980s.
Yep.
They generally are tremendously operationally intensive because they have to go in and look at a client's portfolio, which names, is there enough vol to actually hit premiums, and then if they don't have an execution desk, they have to do it themselves and then roll it, which is quite intensive. So one of the benefits is that we offer the service. We will do the rolls, we will manage the collateral, we will do the margin management. And more importantly, I think people forget is if you want to exit the strategy, you have to buy back and unwind all your trades.
Right.
And now
so
all you have to do is just
remove
sell
that
a shell.
liquidity, that liquidity constraint, right?
Correct. And then the other use case is really for folks, people are more and more dependent on the investment income they're generating. So the tech stocks tend to be higher vol relative to other sectors in S&P 500. So you're able to harvest that vol premium for those particular names.
Okay. And you got them in basically the mags. Great ticker for the Google one, by the way. Goop. Didn't get any hate from Gwyneth Paltrow on that one?
We're waiting for a call from her.
Waiting for a call from her. Okay, nice. Howard Chan, great stuff. Congrats on the 10 ETFs listed here at Cboe. Howard Chan, CEO at Kurv Investment Management. Great stuff.